Let's get to Art Hogan, Chief Market Strategist at B. Riley Wealth. It could give you a sore neck, couldn't it, trying to track this market going up and down. Art, what are your thoughts this morning?
Well, I'll tell you this. I think that we unsuccessfully spent about 7 weeks trying to price in some results of what this trade war and tariff announcement would look like. So when we realized everybody got that wrong by a large margin, we spent 2 days trying to reprice markets and took 10% out of the market rather rapidly over a 2-day period. So at that point in time, I think markets were set up for a bit of a bounce. Clearly, any modicum of good news was going to help us bounce pretty hard. We saw that yesterday with one erroneous headline moving markets 8% intraday, one of the largest swings we've seen in S&P 500 almost ever. But I think that right now we're getting to that sort of that step in the process where we're keeping our ear to the ground for any kind of negotiation process. So whether it's the U.S. and Japan, which seems to be going on right now, hopefully we're going to hear more about the U.S. and Canada, U.S. and Mexico, probably a bilateral deal is being discussed with India. Those types of data points and information flow will help investors and consumers and corporate CEOs feel more confident and start getting back to the sort of normal way of living their lives, making decisions, making investments, hiring people. Right now, we've been frozen for the better part of 2 months. That's going to show up in some economic data, but certainly if the duration of this tariff war is shorter and starts to wind itself down over the course of the next couple of weeks and months, I think we can get to the other side of this and investors will see we probably overdid it in the drawdowns.
We are awaiting Q1 numbers, and presumably on the conference calls, CEOs will be expected to provide some kind of forecast as to what these tariffs will do to their business.
Yeah, that's probably going to be the hardest job of any CEO's job this particular quarter, because there's still going to be, a multitude of unknowns. And I think that that's the difficult thing to guide around. If you don't know exactly what your input costs are going to be for the next 3 quarters, it's very difficult for you to say, this is what our revenues and profits should look like, and here are our CapEx plans, and here's how we plan to deal with this. So I think there are certain companies that have been very good at this, and in terms of through the pandemic, finding multiple supply chain sources. But clearly, that even in and of itself, with a broad, sweeping, universal approach to this trade war, it's hard for any manufacturer of goods to let you know exactly what they think the future looks like. So I think you're right. I think the guidance is probably going to either be blank or look very dark.
If somebody came to you, Art, and said, look, I've got money, I don't mind a bit of risk, should I put cash into the stock market with a time horizon of, say, 6 months? What would you say? I know that's a very tough question to answer.
Yeah, that is a tough question. I would say that a pretty fair amount of the negative has been priced in here, and none of the positives. And by none of the positives, I mean new administration that was ushered in with the hopes that it would be pro-growth and pro-business, perhaps keep corporate taxes low, certainly provide a lighter regulatory touch, and we've heard none of that piece of it. We'll likely get to a place where we have more answers and questions on tariffs and trade. And once we get to that point, I think some of the positive attributes of this new administration may start to kick in psychologically and fundamentally. So I would say within that time horizon, you're probably in a good place here in this market. We've gone from an S&P 500 multiple of north of 23 down to just above 18 times. So at that level, you're finding a much better entry point. And I certainly think on a short-term horizon, there's probably more good news than bad news.
The Wall Street obviously is sending signals to President Trump that they're not happy. Jamie Dimon, the likes of Bill Ackman, Stanley Druckenmiller. Do you think that carries much weight with the administration?
It's hard to know what carries weight with this particular administration. I certainly think they listen to everybody. I think that we're getting to a point, though, where the inner circle is starting to break up a little bit. I think the Treasury Secretary is going to have a louder voice than the Commerce Secretary. I think that Peter Navarro and Elon Musk's relationship has deteriorated and likely will have a separation at some point in time. And that's likely good, right? So, having too many opinions and too many voices around you and not having that right adult in the room to say, this is actually what we should be talking about in terms of our goals and our policies and what we'd like to get to with trade.
Yeah, it is fascinating. I mean, apparently the people not happy with the Commerce Secretary, feeling he's been intemperate with his Howard Lutnick. He's been a bit of a loose cannon when talking about trade.
Yeah, it's it's one of those things where you have to have a modicum of reserve and understand that everything you say can have a negative impact on what you're trying to accomplish. And it's difficult, as you and I know on live TV. Sometimes you can make a mistake.
Oh yeah. Oh, yeah, tell me about it, yeah. Let's have a look maybe at the NASDAQ 100 and check out Tesla. Tesla rebounding last time I checked it in pretty spectacular fashion. Do you think some of these tech stocks that have been beaten up the most are still cheap?
Well, I would tell you this. So even before the 10% drawdown we saw last week, technology was the worst performing sector in the S&P 500. So while people are trying to de-risk their portfolios, tech was the first place they went. The second place they went was consumer discretionary. So those two sectors are the most beat up. You'll notice when we do get these rebounds, those are the sectors that are catching most of that rebound. So I think that makes sense, right? So you come into this with the most oversold sectors likely getting the most attention. And the flip side of that is you'll likely see some of the defensive trades, whether it's consumer staples or energy or healthcare, that have really seen most of that defensive safe harbor bid likely have a chance to mean revert a bit. So I think that if you wanted to put on a barbell trade, that would be the way to do it. You want to sort of allocate to the winners of the first 3 months this year and look at some of those losers, because the collateral damage in tech has been massive.
What about bonds? Maybe we'll put up the old US 10-year yield. Would you be inclined to take refuge in bonds to boost your allocation to bonds right now?
Well, I would tell you it's always good to have that sort of 80-20 or 60-40 portfolio mix. There's only 1 year, I think, in the 30 some odd years that I've been doing this, that hasn't helped you. And I would say at current levels, it certainly is looking attractive, right? So we had a yield on the US 10-year that went from 4.8% down to 3.8% in a span of about 3 weeks. So that was a massive move for treasuries. I think now that settles in and we start to sort of think about things more fundamentally than just that safe harbor that treasuries seem to be, I think you're probably in a good place there, especially for that portion of your portfolio that helps buffer some of the volatility we see in equities.
And Art, just before we go, you have been around, I think you said about 30 years in the markets. You're still in the first flush of youth, we know that. But tell us, have you ever seen a situation like this where a move by the administration caused such turmoil?
Well, I would tell you none of us has seen a point move like we saw the Dow Jones Industrial Average yesterday. And unless you were around in 87, which I was, nobody's seen an 8% move intraday on the S&P 500. And the causes for that have always been different. This is the first time it's come from unannounced trade policy that caught everybody by surprise. Oftentimes it's something else that leads up to this kind of volatility. It can be portfolio insurance in 1987. It can be the crash of a dot-com bubble in 2000, 2001. Certainly the great financial crisis had other internal causes for that. We had created a lot of terrible product that banks sold too much of, and that had to be unwound. But I would say this is this kind of volatility we've seen sporadically, call it once every decade or so, but the causes are always different. This particular cause was just being caught off guard by just how aggressive the initial rollout of a new trade policy was.
We'd better go. Art, thank you so much as ever for joining us.
Great to see you.